we made it to the JSE. Jonga, I am super excited. I don't know what this day has in store for me, but I'm excited. Let's go. Sabana. Hello. I'm here for the Think Investing Conference. Zizipo. Yes. B3.
Straight to 10 and left. So I'm getting B3 to
Alright,
yeah, definitely a more flexible vehicle. It does historically come with a higher cost, but there is definitely a place for those structures.
Okay. Maybe just to add, I think there is a place for both structures, right? And a few years ago we saw this shift from investors from CIS structures into models, and that was largely
what happens to South African interest rates. Again, you can debate a number of these issues. There will be questions raised about the stability of the GNU, and we can unpack some of those. But again, if you just break it down to the math of returns, there's really three components, as Anton mentioned. What is the dividend that you're earning? What's going to happen to earnings growth? And then what's going to happen to the multiple that investors will pay there? You can see is really actually a mirror image compared to the US equity slide.
And frame it in the context of the last 10 years. Because 10 years ago, the only story in town was China. Businesses are being opened up, their flow of capital, obviously opening up to the market, and the story which we know for the last 10 years has just gradually deteriorated, as we've seen with the economy, to the point where we got to the beginning of this year where the valuations of Chinese equities relative to the US reached off the charts types of levels. So very simply, our models basically say, well, look, at this point in time, how much buffer do you have in valuations for you to make allocations to China? And our models tell you, effectively, it was a beginning of the process of us increasing overweight in China. We've been gradually increasing that, predominantly through Hong Kong, but increasing our exposures to China over the course of the last 12 months. Not a call on anything to do with the politics or the economy. Got opinions on that, but it's not something which impacts the way we allocate assets. Whenever market gets extremely oversold, everyone's bearish, everyone's selling, uninvestable, all these bits and pieces. Then if you have a long-term framework, valuations-based approach, and you're very methodical in how you allocate that, it's always a fantastic opportunity. 9 times out of 10, we'll talk about the 1 out of 10 if you've got, but 9 times out of 10, it's the way to allocate that. So that's what we've been doing. The gold, I'm not the person to talk to, but once again, I've got a cup of coffee, we can talk about gold, but we don't allocate to gold, our funds.
Kind of an industry overview and industry review. So I'm going to go through a whole lot of interesting stats. A lot of this has been amalgamated and kind of like a literature review. We've tried to put together a whole lot of really factual evidence around where flow of assets are gone, where they're probably going, bring it into South Africa, and then maybe have a bit of fun on a parallel. But I don't want to speak for too long. I want to open it up for a lot of Q&A, because I think the way that asset managers change and evolve their business models is going to be hugely impactful on how advisors and intermediaries and end clients see their investment solutions shaping over the next 5, 10, 15 years. Gold market, by the way, it's quite hard to get very reliable institutional data. The institutional market probably takes you up to more like 7, 8, just to give you a flavor of the size of our market, which is tiny. 14% growth, which is great. This is as we unlocked out of DB to DC, as the life co started letting go of assets, And as the independents and the boutiques, and when I talk about the boutiques, I mean non-life type businesses, started coming to market, pretty substantial growth in our savings and investment markets. Only about 60% of this comes from the market, so quite different to the global experience. We obviously tend to be 10 years behind the global experience in terms of the maturity of our asset management market. So really pretty
structured, unsophisticated, small scale, low tech, and so on and so forth. And as you'll see, this isn't true to a vast proportion of businesses out there. And also this informal sector in many ways is the future of economic activity in South Africa. When I tell people that I'm involved in the kind of township or informal economy, they go, spaza shops. It drives me absolutely crazy because in most people's minds this is the idea of what the informal economy is. And while there's many of these kind of spazas, or what people often call opijima mfana, which means run child, because the vast proportion of purchases are a child given money and running down the road, the reality is that the sector is actually very different, and spaza shops are only one small part of this economy. So as an example, this lady over here on the top is Miriam. Miriam wakes up at 2 in the morning and she goes down to Baragwan with taxi rank in Soweto, and she starts making amagwinya or vetkoek, and at 3 o'clock she starts selling. By 10 o'clock she sold almost 2,000 amagwinya for R1.50 each. And she makes about anywhere from 500 Rand to 800 Rand depending on the time of the month every single day from selling that. Then at about 10 o'clock she starts selling garabao, deep fried horse mackerel, and she does a couple of hundred of those by about 2 o'clock in the afternoon. And
What an insightful day it has been. Now I have to go look for my car. I've parked really far because I was a bit late. This is a steep going down the steep. So awesome day, very insightful, very educational, and great stuff. One of the things that really stood out for me in the discussions that were held at that Think Investing convention is the overview of how they see the market in the next coming years and their expected asset class returns, right? So what I got from that is, firstly, they are very bullish in the South African equities. By bullish, I mean they are very aggressive in terms of their investments in the South Africa's equities. And this is due to how they view this current environment as promising and as investable. Their view really is based on the success of the GNU, which I'm kind of like, okay, we just had this new government of national unity, and we haven't seen many inflows from investors globally. For them to be seeing opportunities in the local market, I don't know about that. But one of the other things that stood out is the fact that, okay, now asset allocators have been given this mandate by Regulation 28 to invest up to 45% of their assets in the local environment, right? And normal or traditional asset allocators are going to look at the stock market in the JSE. They gonna look for, the equities, the bonds, the government bonds, the inflation linked bonds, and all the traditional assets, right? But what I didn't see from, the asset manager's presentation is the private equity sector. I mean, you have a chunk of 45% to invest in South Africa. Firstly, the domestic markets have not been performing well in the past few years. It's a very low return environment, and now these asset allocators, they are very bullish in this kind of environment. That was my question number one. Number two, they haven't mentioned anything about the private equity, of which I feel like asset managers at this point in time should be discussing alternative investments, because the traditional markets are not giving the returns that they're supposed to give. Therefore, that means that the retirement funds are not, getting results they want from their funds, So why not look into the alternative investment space? Private equity, for example. Private equity could boom in South Africa because one of the advantages of the private equity investment is the high returns that you get from that investment. At the same time, you are getting benefits from the investment. You can see the benefits from for example, the infrastructure. Private equity infrastructure can be of assistance to many people in South Africa. So here's an opportunity for retirement funds to actually see where their investments are going, to actually benefit physically from their returns, used via private equities. But it's still such a long way to go for South Africa, and it's very worrying at this point, because what's the point of getting returns less than 5% a year in your investments, where you can get more than that, where you can get 30%, 35% returns, So I think asset managers, they need to keep in mind all these views before they are still, stuck in the past, I would say. But anyways, moving on. Another presentation that stood out for me was the last guy that spoke. I think his name is G.G. Alcock. He's an author, a marketer, an entrepreneur, something like that. But basically, he was speaking of Nomics, which is based on Kasi economics. He was basically saying that, there's an opportunity in the space. There's billions of rands to be made in the Kasi economy alone. And what are investors doing about this information? He basically had an outline of how the quota businesses are doing, he had an outline of all the businesses that can be found in Ekasi or in the rural urban areas, and how those businesses end up hitting the wall and not growing. Some have to resort to closing down because of the lack of support from government and private investors. So Gigi Alcock was basically saying, guys, here's an opportunity, jump in. There's money to be made in this economy. And one of the questions that were asked, I think by one of the asset managers, was, okay, you are saying that we must invest in this economy. Therefore, by us investing in this economy, doesn't that make that informal economy now formal, if you are going to have private investors? And then the guy was like, no, these guys need support. Like the woman that sells amagwinya on the streets, if you can offer support, that business can grow to be a reputable business, a business that is in future gonna be sold out to other businesses. think of the street vendors. They can be offered opportunities to, have their businesses in Sandton, So yeah, man, it was such a great experience, and it really got me thinking. It really got me thinking in terms of investments, where to look in the future, and most importantly, from now on going forward, which investments stick out to me, which assets are worth investing on in the future, and even which assets are going to give you the best returns in the long period of time. That's just about it. But really, the investment environment is quite volatile. It is filled with ups and downs, but it's really challenging to a point where you might want to pull out. But what I got from the asset allocators is that pulling out is not an option. You lose more than you even invested when you pull out before time. Therefore, it is good for you to stay invested. Yeah, man, it's been said that shares or stocks are where you're gonna have to build your wealth if you're investing. But the tone has changed drastically over the past few years. Now people are thinking alternative investment space. Where can we invest in the alternative space? And I kind of was disappointed not to hear much about the alternative space. We were still dealing with the asset allocators that are still dealing with the traditional financial markets, which is the stock market. And again, I think we need to start talking differently now. We need to start allocating differently at this point in time, because we are not getting as much value as we are supposed to get. But anyway, guys, tell me what you think. I really want to hear from you. If you like this video, please comment down below, like, subscribe, all those good vibes. Guys, thank you so much, and I will see you in another video. Bye now.